Think about the last time you got paid. Not the number, not what you were expecting to do with it, just the moment, the transfer notification, the deposit confirmation, that brief, specific sensation of having money. Now think about 3 days later. Where did it go? Not all of it, maybe not even most of it, but some significant portion of it gone, already distributed, already spoken for, before you made a single real decision about where you wanted it to be. Most people, when they try to answer that question, come up with a version of the same answer. Bills, subscriptions, food, the usual things, and somewhere in the telling, there's always a moment of vagueness. I'm not sure where that went, but it just sort of disappeared. That vagueness is not carelessness. It is a predictable outcome of a system that was specifically built to create it. Here's what I want you to understand before this video is over. Your money is not disappearing because you lack discipline. It is disappearing because every system around you was designed to take it before you get to decide. That is not an accident. That is architecture. And once you see it, you cannot unsee it. I'm May. For more than 20 years, I worked inside the financial system advising corporations, institutional investors, and individuals whose net worth had more zeros than most people will ever see. I sat in rooms where the decisions were made. I understood, from the inside, how the machinery of money actually works. And the thing that stayed with me, the thing I couldn't stop thinking about when I finally stepped back, was how little of that knowledge ever reached the people who needed it most. This channel is my attempt to close that gap. If that's the kind of content you've been looking for, subscribe now. The next video goes somewhere most finance channels don't. But right now, let's talk about your money and where it's actually going. Let me describe a month. Not your worst month, not a crisis month, just a regular one. Payday arrives. Direct deposit. The number appears in your account. And for a moment, maybe 30 seconds, maybe a few hours, it feels like enough. Then the calendar starts. Rent or mortgage, probably the largest single number, and it leaves first because it has to. Then utilities, electric, gas, water, numbers you don't fully control, that arrive on their own schedule. Then the phone bill, internet, insurance, health, car, maybe renters or homeowners. Each one automatic. Each one set up at some point in the past by a version of you who agreed to a number and a date. Then the subscriptions. And this is where it gets interesting, because most people, if you ask them how many subscriptions they have, will give you a number. And most of the time, that number is wrong. Not because they're not paying attention, because the subscriptions were designed to fall below the threshold of attention. $12 here, $8 there, $14.99 for something you signed up for during a free trial and never canceled, because canceling requires effort, and the charge is small enough that it doesn't feel worth the effort in the moment. But those numbers add up. I've seen people sit down and actually count their recurring charges for the first time and discover they're spending $300, $400, sometimes $500 a month on services they couldn't name if you asked them. Then there's the grocery run. You go in for specific things. You come out having spent 40% more than you planned. Not because you're reckless, because the store was designed to make that happen. The layout, the placement, the end caps, the lighting, the way certain items are at eye level and others aren't. Retail environments are engineered by professionals whose entire job is to increase your average transaction. Then the small daily things. Coffee, lunch, the convenience purchase on the way home because you're tired, and the thing is right there. The online order at 11 p.m., not because you planned it, but because you were tired and a little bored, and something was on sale, and the app made it very, very easy. One click, confirm, done. And then, somewhere around week 2 or week 3, you check the account, and the number is smaller than you expected. Not dramatically, not catastrophically, just smaller. And there's that familiar feeling, the quiet arithmetic of trying to remember what happened, where did it go, the mental accounting that never quite adds up to the full amount that's missing. So you resolve to be more careful next month. Next month arrives. The pattern holds. This is not a story about bad decisions. This is a story about a system that is working exactly the way it was designed to work, and you are living inside it. Here's what I notice when people talk to me about money. They almost never say they want to be rich. Not really. When you get past the surface, past the things people say, because they think they're supposed to say them, what most people actually want is much simpler. They want to not feel this way about money. They want to open their banking app and feel nothing. Not excited, not relieved, just neutral. The way you feel when you check the time, it's information. That's all. They want to have a bad month, a car that needs repairs, a medical bill, a flight home for a family emergency, and not feel like the ground is moving underneath them. They want to stop the specific anxiety that lives somewhere behind the eyes. The one that activates every time someone mentions money at dinner, every time a bill arrives, every time the account is lower than expected and they don't know exactly why. That's not a lot to ask. Basic stability, basic predictability, the sense that you know where your money is and where it's going. And yet, for an enormous number of people, people with jobs, people with incomes, people who are doing what they were told to do, that feeling is elusive. They've tried tracking, they've tried budgeting apps, they've tried cutting back, they've tried being more intentional, more disciplined, more whatever the advice said to be, and the feeling doesn't come. Because the advice was aimed at the wrong problem. The problem was never discipline. The problem was the design. Let me explain what I mean by design, because I don't mean it loosely, I mean it precisely. Your bank is a business, which means it exists to generate revenue. And to understand where that revenue comes from, you need to understand something called the float. The float is the money sitting in your account between the moment it arrives and the moment you spend it. While your money is in your checking account doing nothing, as far as you can see, the bank is using it, lending it out, investing it overnight, earning interest on it. They pay you almost nothing for the privilege. You've probably seen the interest rate on your checking account. It's not designed to reward you. It's designed to be low enough that you don't think about it. The bank's incentive structurally is for your money to move frequently generating transaction fees and to sit in low-interest accounts when it isn't moving. Their incentive is not for your money to accumulate in a high-yield account working for you. That's not cynicism. That's just how the revenue model works. Then there's the subscription economy. The subscription model exists because of one specific insight. A recurring charge below a certain threshold will almost never be canceled. The research on this is consistent. Charges under about $15 per month fall below what behavioral economists call the cancellation threshold, the level at which the discomfort of the charge outweighs the friction of canceling. Every subscription service you use has a pricing team. That team's job is to find the number just below your cancellation threshold. Not to price the service at what it's worth to you. To price it at the maximum you'll pay without actively noticing. And they are very good at their jobs, because the business model depends on it. A subscription company's most valuable metric is called ARPU, average revenue per user. They don't grow ARPU by making sure you're actively choosing to pay every month. They grow it by ensuring you never actively choose to stop. 12 services at $12 each is $144 a month. Most people, if you ask them, would not say they spend $144 a month on subscriptions. Most people would be wrong. Now let's talk about your employer's payroll structure. This one surprises people. Your payroll cycle, bi-weekly, semi-monthly, monthly, was not designed around your financial life. It was designed around your employer's cash flow management. Large organizations pay employees in bulk cycles because it's administratively efficient and because it gives the company a predictable window for cash flow planning. But here's the consequence for you. Your income arrives in large, infrequent deposits. Your expenses arrive in small, continuous withdrawals. That mismatch creates a predictable pattern of feast and famine within the month. A large number that feels like abundance, then a slow drain, then a number that feels like scarcity, even though the math for the whole month might technically work out. The psychological experience of that cycle, the high at payday, the low by week 3, is not accidental. It's a structural consequence of how payroll was built. And it makes saving harder, because saving feels most achievable at the start of the cycle when the account looks full. But that's also when the largest bills arrive. By the time the money settles, the impulse to save has quieted because the number is smaller and protection mode kicks in. And finally, the e-commerce and retail layer. Every platform where you spend money has been optimized to reduce what's called purchase friction. Purchase friction is the psychological resistance between wanting something and buying it. Historically, friction was natural. You had to go to a store. You had to find the thing. You had to interact with the cashier. You had to hand over physical money, which activates a different part of the brain than a tap or a click. All of that friction created space. Space for second thoughts. Space for the impulse to cool. That space has been systematically eliminated. One-click purchasing, saved payment information, autofill, in-app purchases that require only a fingerprint, notification-triggered opens that take you directly to a checkout screen. The product teams at these companies have one measurable goal: reduce the time between interest and purchase. Every second of delay is a conversion they might lose. So they remove the delay, and in doing so, they remove your pause. The moment that used to exist between I want this and I have bought this, the moment where you might have decided it wasn't worth it is gone. So let's be honest about what you are up against. On one side, your intentions, your resolve to be more careful this month, your attempt to track spending, budget categories, and exercise discipline. On the other side, entire industries. Teams of behavioral economists, product designers, data scientists, pricing strategists, and UX researchers, all professionally employed to ensure your money moves in a specific direction. That is not a fair fight. And the advice to just try harder, the advice that implies the problem is your effort, is advice that has never understood what game is actually being played. You are not failing at discipline. You are losing a structural battle that was designed for you to lose. The answer is not more effort against the same design. The answer is a better design. Everything I'm about to tell you is simple. I want to say that first, because in financial services, there is a professional incentive to make things sound complicated. Complexity justifies fees. Complexity creates dependency. What I'm going to tell you is not complicated, it is structural, and that distinction matters. The first move: automate your savings before anything else touches your money. There is a principle called paying yourself first. It is not new. It has existed in various forms across financial traditions for a very long time. But most people who've heard of it think of it as motivational advice, a mindset shift, something to try. It is not a mindset shift. It is a structural intervention. Here is what it means. Precisely. On the same day your paycheck arrives, or as close to it as possible, move a predetermined amount out of your main account and into a separate savings account, automatically, before you see it, before you spend it, before any subscription charges it, before any purchase is considered. Not save what's left at the end of the month. Not set aside some when it feels like a good month. First, automatically, every cycle, without deciding. When you do this, when savings moves before spending, you have reversed the architecture. The system was built to extract your money before you choose where it goes. You are now doing the same thing, but in your own direction. You are making your financial future the first automated payment of the month, before the subscriptions, before the landlord, before the impulse. How much to start with? This question stops most people because they hear numbers 20%, 30%, and the math doesn't work for where they are. Start with whatever does not hurt. That precisely. Not what's advisable, not what the rule says. Whatever amount, when it leaves your account automatically on payday, you will not feel. For some people, that's $50. For others, it's $200. The number is not the point. The point is the structure. The point is that it moves automatically. The point is that it happens before you have the opportunity to spend it. Once the structure is in place, you increase it incrementally, $10 or $20 more each month. Not dramatically, slowly, until you reach an amount that is meaningful without being painful. The psychology here is important. Most people find that they do not miss money they never see. The account adjusts. The spending adjusts. Not perfectly, but enough, because you were already spending without it. The money was already disappearing before you touched it. Now it's disappearing into something you chose. The second move, the quarterly subscription audit. Once every 3 months, sit down with 3 months of bank and credit card statements. Your only job is to find every recurring charge, every subscription, every auto renewal, every service, every membership, every app that's charging you annually and has been doing it quietly for 2 years. Write them down, every single one, with the amount. Then ask for each one a single question. If this service stopped existing tomorrow, would I notice? Not do I use it? Not is it worth the money? Would I notice? Because there is a category of subscription that you're paying for, not because of the value it delivers, but because you set it up, forgot about it, and the charge has become invisible. That money is not spent. It is leaked. In my experience, both from my own finances and from watching this process with others, the average person finds between 3 and 6 services in this category. At an average of $12 to $15 per service, that is somewhere between $40 and $90 a month being recovered. Not from sacrifice, not from cutting things you want, from closing the leaks in a system that was designed to leak quietly. The third move, one account that is not for spending. Separate your savings from your checking account, not just in category, physically, a different account. Ideally at a different bank, or at minimum with no debit card attached and no easy transfer option visible on the main app screen. The reason for this is behavioral, not mathematical. When savings sits in the same account as spending money or in the same app with one tapped transfer, it participates in every spending decision. Every time the account looks lower than comfortable, the savings is visible and accessible. Separation creates friction. And in this context, unlike the friction that retail companies work to eliminate, friction is your ally. The 2 seconds of delay between wanting to access savings and actually accessing it is enough to interrupt most impulses. The money's availability hasn't changed, but its psychological proximity has. You are using the same mechanism the system uses against you, friction as a behavior design tool, but in your own favor. One more thing, and I'll be direct in a way that most financial content isn't. A standard savings account at a major bank is probably paying you close to nothing in interest. In some cases, literally nothing. High-yield savings accounts available through most online banks and a straightforward internet search away are currently paying meaningfully more than that. Not enough to change your life, but enough that your money is doing something while it sits there. The difference between your money earning close to zero and your money earning something is not a trivial distinction over time. Check what your savings account is actually paying you. If it's less than 1%, look for an alternative. That is a 20-minute task. It does not require a financial advisor. Here is what 90 days looks like. Not a dramatic transformation. Not the version of this story where everything is solved. Just 90 days. 3 months of the structure working. Your savings account has a number in it that wasn't there before. It's not a large number, probably, but it exists. And it's moving in one direction. Your recurring charges are leaner than they were because you did the audit and you closed some of the leaks. Money that was previously disappearing into services you'd forgotten about is now disappearing into savings instead. Your main account, by the end of the month, looks slightly more like it did at the beginning, and the anxiety, that low-grade financial anxiety that most people carry so constantly, they've stopped registering it as anxiety and started thinking of it as just life it quiets. Not because the number is large, because for the first time, the money is going somewhere you decided. That's the thing I want you to take from this video more than any specific tactic. The system around you was designed to move your money without your meaningful input. What you are doing when you automate savings first, when you audit your recurring charges, when you create separation between what you're spending and what you're building is reclaiming input. Not perfectly, not all at once, but enough to feel the difference between money that just leaves and money that goes somewhere you chose. That's not a small thing. For most people, that feeling is what they've been trying to find for years. If you grew up in a house where money was never explained, if nobody ever sat you down and showed you how any of this actually works, this channel is for you. Subscribe. The next video goes into something most people spend years getting wrong without understanding why. And before you go, I want to ask you one thing, not about your budget, not about your income. What is the thing that takes your money before you get to decide? The specific one. The one that's there every month without you choosing it. Write it in the comments. I read everyone.